You can buy shares of the best company in the world and still lose money. And the scariest part? This mistake is so silent that most people only realize it when it's already too late. Today, I'm going to show you how to avoid this trap and reveal the magic formula that can transform the way you invest forever. And since what we're going to talk about here can change your wealth in the coming years, go ahead and subscribe to the channel and leave a like now. That way you won't miss upcoming content and you'll ensure your money works harder and smarter for you. Maybe you've already been through this. You find a company with impressive results, industry leaders, growing profits, and think it's impossible to go wrong. You buy the shares confidently, sure you made a great deal. But weeks or months later, the price starts to fall. At first, it seems like a normal correction. Then, it turns into a painful drop. And before you realize it, that perfect purchase has turned into a loss. This doesn't happen only to beginners. Experienced investors, renowned managers, and even billion-dollar funds have fallen into this trap. The reason? They confuse a good company with a good investment. These are different things, and that's where the danger lies. When you buy a company just because it's good but ignore timing and price, you're essentially gambling in the dark. It's like paying any price for a beautiful house without checking the neighborhood, history, or market value. And this mistake is silent. You don't notice it when you buy. You only feel the impact when you're already losing money. What most people don't realize is that investing and buying shares are not synonyms. Investing means putting money into something that will generate a return with calculated risk. Buying shares, on the other hand, can be just an impulsive, emotional act driven by momentary excitement. The silent mistake starts when the investor finds a good company and, without deeply analyzing the price and context, assumes they're making an excellent deal. The logic seems simple. If the company is solid, innovative, and profitable, my shares will appreciate. But reality is much more complex. A classic example was Apple in 2012. The company was, and still is, a giant of innovation, with record profits and a loyal customer base. But those who bought its shares at the peak that year had to wait years to see real returns because they had paid too much. The company's quality didn't change, but the price paid determined the investors' experience. This mistake is fueled by two factors: collective euphoria and selective confirmation. Euphoria happens when everyone praises a stock, newspapers, influencers, investment groups. Social pressure creates false urgency. Selective confirmation is when you seek only information that confirms your decision, ignoring warning signs. Another example is Tesla in 2020. Those who bought at the height of the hype, excited by headlines, saw their capital shrink quickly. The company still had good fundamentals, but the price paid was way above justified value. The average investor rarely realizes they fell into this trap at the moment of purchase. After all, the company's numbers stay good, the news remains positive, and reports continue optimistic. But the chart starts telling another story. It's in this gap between purchase and loss realization that the mistake becomes silent, because you don't feel it immediately. Only see your wealth slowly erode. This phenomenon repeats in cycles. And if you don't recognize it, you're doomed to relive it several times, believing it was bad luck or the market is unpredictable. In fact, the predictability lies in the mistake. Paying too much for something good is still paying too much. Paying too much for a good company is not just a technical error, it's a silent thief of wealth. And the effect of this mistake doesn't show dramatically, but as a slow, almost imperceptible erosion that undermines your gains over time. Imagine two investors. The first buys shares of an excellent company, but pays the price the market inflates during euphoria's peak. The second waits patiently until finding the same company trading at a fair or even cheap price. In the short term, the first feels good. After all, They are part of the movement and hear everyone praising the company. But when the market adjusts the price to reality, they face a drop that can take months or years to recover. Meanwhile, the second investor starts harvesting fruit sooner, with a greater margin of safety and return potential. This is the power of entry point. It determines not only your profit size, but also how long it takes to achieve it. A poorly paid price can mean years of waiting just to break even. And in that period, many give up. They sell at a loss, lose confidence in the market, and worst of all, miss truly advantageous opportunities for fear of repeating the experience. This cycle of euphoria and frustration pushes smart people out of the investment game, and all of this could be avoided if there was a method to filter opportunities and ensure you're not just buying a good company, but a good investment. So far, you've understood the silent mistake and how it erodes your wealth. Now the big question is, how to avoid this trap? That exact search led me to study some of the greatest investors in history. People like Warren Buffett, Benjamin Graham, and especially Joel Greenblatt. They all have different approaches but share an unshakable principle. It's not enough to choose excellent companies, you must buy them at the right price. And Greenblatt, in particular, simplified this philosophy into a nearly surgical, easy to understand and apply method combining quality and price objectively. He called it the magic formula. It's not a miracle solution, but it's a powerful filter that can transform your decision-making process. And now I'm going to show you exactly how this formula works, step by step. The magic formula was created by Joel Greenblatt, a legendary investor who achieved impressive returns throughout his career. The name may sound exaggerated, but the idea is simple. Find excellent companies and buy them cheaply. How does he do it? Using two key indicators. First, return on capital, which measures a company's efficiency in generating profits with the money invested in the business. Second, earnings yield, which is the company's profit relative to its market price, basically the inverse of the PE ratio. The process is straightforward. You take a universe of companies, rank them all by return on capital from best to worst, and also rank by earnings yield from highest to lowest. Then, sum the positions of the two lists. Companies with the lowest total are the most attractive because they combine high quality with good price. Why does it work? Because the market often gets excited by pretty stories and ignores solid companies temporarily off the radar. The magic formula helps you separate noise from opportunity. Imagine two companies. Company A has a return on capital of 25% and earnings yield of 12%. Company B has a return on capital of 10% and earnings yield of 5%. According to the magic formula, Company A tops the list because it generates high profit with its capital and trades at an attractive price. Greenblatt tested this strategy for years and achieved annual average returns far above the market. Of course, it's not foolproof and there are down periods. But in the long term, quality plus fair price beats most investors who buy only good companies without considering purchase. Timing. Before applying, know this isn't a get-rich-quick formula. It's a methodology to discipline your decisions and reduce the chance of overpaying. Patience is required, because some picks take months or years to appreciate. It's also crucial to use reliable data to calculate indicators correctly. The magic formula works best when applied consistently, not as a one-off bet. Greenblatt recommends building a diversified portfolio of the top-ranked companies and reviewing it periodically. Now that you know the logic, let's see how to apply it in practice. First step is to define the universe of companies you will analyze. It can be the list of stocks traded on the US exchange, like the S&P 500 or NASDAQ, or a more focused selection depending on your profile. Then, you need financial information to calculate return on capital and earnings yield. This information is available in financial reports, specialized websites like Yahoo Finance, Morningstar, Finviz, or tools like Bloomberg and FactSet. Next, Organize all companies into two lists. One ranked from highest to lowest return on capital, another from highest to lowest earnings yield. Now sum each company's position in both lists. The company with the lowest total ranks at the top. To make decisions, I recommend building a diversified portfolio with the top 10 or 15 companies from the list, helping reduce risks and avoiding dependence on a single bet. Maintain discipline and review periodically. Reassess rankings and portfolio quarterly or semi-annually. The market changes, and a company doing well today may not tomorrow. Don't be driven by emotions. The magic formula is a medium to long-term methodology, so fluctuations are normal. Resisting the urge to sell during dips makes all the difference. If you don't want to do manual calculations, there are digital tools and spreadsheets that automate the process. I've even prepared an exclusive spreadsheet to make your journey easier. Stay until the end to find out how to get it. This blend of quantitative analysis and discipline puts you ahead of most who gamble on emotion or popularity. Speaking of results, Joel Greenblatt achieved average returns close to 30% per year over long periods, outperforming traditional indexes like the S&P 500. Many independent investors have also replicated the formula, confirming similar results, especially when applying it with discipline and patience. Academic research shows strategies combining quality and fair price tend to outperform the market long-term and reduce risks. No method is foolproof. There will be downturns and temporary losses, but consistency and commitment to the process make all the difference in building sustainable wealth. Before abandoning your shares out of fear or following market fads, remember, the magic formula is a tested system with theoretical and practical support that helps you invest smartly and safely. Now, to conclude, I want you to understand that knowledge is not enough. You must act, apply the formula, stay disciplined, and be patient to reap the rewards. That's why I prepared an exclusive spreadsheet that automates this whole process for you, with a simple and easy-to-use step-by-step guide, perfect for those wanting to turn theory into real results. Subscribe to the channel, leave your like, and hit the bell so you don't miss the next videos where I'll release this spreadsheet and more tips to turbocharge your investments. Also, leave in the comments, what was the biggest mistake you ever made when investing? I want to hear your story and help you turn this game around. Remember, it's not about guessing the future. It's about buying the future cheap. Start now with method and intelligence, and build the financial freedom you deserve. See you in the next video.